Financial accounting concepts. Concept of business entity. A business and its owner should be treated separately as far as their financial transactions are concerned. Proprietor. A proprietor is a person who brings capital into a business. He is the owner of the business. Capital. Capital is a sum of money or anything else which a proprietor brings into a business for continuation of the business. For example, Prakash started a business with cash of rupees 50,000 and a tempo of rupees 4,50,000. Here, the total capital invested by Prakash in this business is rupees 5 lakhs. Liabilities. Liabilities are the amounts payable against credit purchases. Long-term liabilities. These are liabilities which will take more than 1 year to pay. For example, furniture loan taken for 2 years from the bank. Short-term liability. These are liabilities which will take less than 1 year to pay. For example, goods purchased on credit for a credit period of 30 days. Assets. Assets are things or properties which are bought in to continue a business and which have value. For example, furniture, vehicle, land, building, etc. Fixed assets. These remain in the business for long term and are not purchased for selling. For example, land, building. Current assets. These are converted into money within a short period. For example, debtors, bills receivable. Drawings. This is the amount or goods used by the proprietor for personal use. Goods. These are products which are sold in order to earn money for the business. Purchase. This is the method of buying goods. Goods are purchased for resale or for production. Cash purchase. When goods are purchased and the amount is immediately paid to the supplier, it is called a cash purchase. Credit purchase. When goods are purchased and the amount will be paid in future to the supplier, it is called a credit purchase. Sales. Cash sale. When goods are sold and the amount is immediately received from the customer, it is called a cash sale. Credit sale. When goods are sold and the amount will be received in future from the customer, it is called a credit sale. Stock. This is the goods in hand. Stock can be semi-finished or finished. Opening stock. This is the stock in hand at the start of the financial year. Closing stock. This is the stock in hand at the end of the financial year. The closing stock of 1 year becomes the opening stock of the next year. Debtor. This is a person to whom goods are sold on credit. Creditor. This is a person from whom goods are purchased on credit. Expenses. This is the amount spent on production of goods. Expenses are divided into 4 categories. Direct. These expenses are directly related to the production of goods. For example, labor charges or wages paid. Indirect. These expenses are not directly related to the production of goods. For example, salary paid. Administrative. These are expenses that are not directly related to a specific function, such as manufacturing, production, or sales. For example, audit fees or legal fees. Selling. These expenses include any costs incurred by the sales department. For example, sales team salary and incentives. Discount. Trade discount. A discount given by a seller to a buyer as a deduction in the list price of a commodity is called trade discount. Trade discount is given to promote bulk sales. Cash discount. A deduction in the invoice amount allowed by the seller to the buyer in return for immediate payment is called cash discount. Cash discount is given to encourage prompt payment. Income. This is the amount earned by selling finished goods. Losses. If income is less than expenses, then it is considered as a loss.